Shubaris has been a tremendous support and a guiding force of our program. Our guest of honor, Mr. Anurag Mishra, and students of Matrix. Dear students, Matrix believes in leveraging the management competencies amongst the MBA graduates for business and industry by expanding their horizon and with updated information in the field of management. In continuation with that, our Honorable Director, Professor Dr. Satish Ubari sir, has initiated 4 Dimension lecture series where we invite renowned experts from different fields of academics and industry who share their experience with the students, which helps them to improve their knowledge and employability skills. It's my pleasure to introduce you a professional with a wealth of experience across multiple industries, Mr. Anurag Mishra. Anurag Mishra, sir, currently serves as a deputy manager at Grow Indigo Private Limited, where he excels in business planning, fundraising, and cost efficiency strategies. With a strong background in financial modeling, market research, and commercial negotiations, he has played key roles in various organizations, including TVS, Supply Chain Solutions, Tech Mahindra, and SG Analytics. Anurag sir holds an MBA in Finance and ICFAI Business School, Pune, and has demonstrated a deep commitment to driving growth and innovations throughout his career. Welcome, sir. And I request you and all the students to please open up your camera so we can have a group picture with sir. Everyone, please open up your cameras. Pranjal, Neeraj, Anuj, Somnath, Suyash, Karat, Rushikesh, Prashant, Shrutika, everyone. Prashant, Abhay, Payal. Mohit sir, please let us know. Mohit sir, please let us know when you're done.
Done, ma'am.
Okay. Thank you, sir. Now please open your cameras so we can start the session. Over to you.
Okay. Okay. Thanks, Munal, for the introduction.
Wow.
I hope you guys are able to hear me properly.
Yes, sir.
I hope there is no background noise or anything. No
No,
echo.
sir. No, sir. No, sir. Nothing. Okay.
Okay. Perfect. So today's topic, as we have already seen on the screen, it's strategy formulation and decision making in the company. So I would talk about strategy at first. Like, what exactly is a strategy? A strategy is basically a plan of action. In simple terms, it's a plan of action which the company and the CXOs formulate in order to drive the business. Okay. So we'll talk about like why it is required in the first place. So a strategy is basically required because, as I said, it's a plan of action. So if you are not having a plan beforehand, you'll not be able to guide your business. Okay, so for guiding a business, for channelizing the business in a right direction, you need to have a plan, and that is where this strategy formulation comes into picture. Then, if we talk about like who all are the parties who are involved in this, so it's basically done at a top management level, then it's passed on to the middle management level, and it's executed by the lower management level. Sorry, the lower hang of the people. So that's basically your executive associate or analyst level person. So yeah, the middle level management is basically it consists of your managers and the others, and the top level is basically the CXO level. So the CXO level formulates the strategy. It then goes down to the middle level management, and then it's passed on to the lower part. Then like it's formulated for the audience. Basically, for this strategy can be your internal folks and can be your external stakeholders as well. So sometimes it's formulated for the investors, then sometimes it is formulated for the government. So there can be n number of stakeholders. that you guys will be learning during the course of your MBA, that who all are the potential stakeholders for a company. So it's formulated for these people. Then when now we'll come up to how this strategy is being formulated. So like what exactly are the tools that the company uses in order to formulate these kind of strategies that will eventually help the company in the decision making process. So that's kind of simple. So like when you are at a CXO level, what exactly do you look at? So for the lower level and for the middle level management, it's basically your operational related things that they are more focused on. If you'll talk to an analyst level or associate level person in a company, they will basically talk about the nuances of the day-to-day operations. Okay, day-to-day business as usual, as we say in our business language, they'll talk about that. But when you go to the top level, they will basically focus on the what the profitability looks like, where or in which heads these costs are, like the whatever the costs that are coming, they are say higher in which head. Okay, and then they will talk about from where I'll be able to like say reduce my debt, or from where I'll be able to reduce the interest which has been implied on the debt, from where I'll be able to like say reduce my taxes in order to increase my profitability. So they will, their focus is more towards the profitability and the cost and the like the higher end of the things. Okay, so they basically look upon three things. So those three things are your financial statement, which basically gives you a overview of how your business is functioning. So they are not too much involved into the operational part of it, because anyways the middle level and the lower level is there to cover it. So they are more focused towards what are the things that affect at the businesses at a higher level. Okay, so now we'll talk about the income statement, which is one of the three financial statements that the CXOs look for in order to formulate the strategies and in order to make their decisions, so that they'll be able to drive their business. So, first of all, I would like to understand from the students, like, have you ever come across the income statement as per Companies Act 2013? Has anybody saw it previously, or are you guys reading about it? Anyone? You can raise your hands, or you can switch on your camera and like switch on your mic. Hello, can you hear me?
The sir is asking something. You can interact with them.
Yeah, I don't want this to be a one-way interaction here, because in that way I'll be all speaking and you guys will definitely get bored out of it. So
Yeah.
yeah, I'll rephrase my question again. So have you guys read, or have you guys saw the income statement as per Companies Act 2013? Like it's a vertical income statement.
No, sir.
Okay, so you guys are following the traditional income statement with a debit on the left and a credit on the right? A T form of income statement, or a profit and loss statement that you call. Am I correct?
Yes, sir.
Okay, so this will be going to be a homework for you guys, that look out for any of the listed companies, say ITC, HUL, or any of the banks, HDFC, ICICI, and look for their income statement, how they are putting it in their annual report. So just look out for that and understand what exactly the income statement looks like. Okay, and just mind you guys that whatever you will see as an income statement in the annual report, that is based on as per the Companies Act 2013, and that is also based on as per Indian accounting standards what the company has to give in their annual report. But the income statement, in a way that has been looked in the internal company matters, looks a bit different. So I'll give you a flow of like a hang of how the income statement is being looked by CXOs internally in the company, so that you guys will be getting more clarity, and that will eventually help you guys in your career progressions as well. So, in the income statement, the very first thing that comes up is the revenue. So, anyone who can give me what exactly a revenue is for the company? Like, what is the meaning of a revenue?
Including the taxes plus charges.
Okay, somebody has written revenue is profit. So, who is this? So, Dhaneshwari, profit and revenue, they are two different things. They're not the same.
Hello, sir.
Yes, Sai Kumar?
Sir, yeah, revenue is the money a business earns through selling its product or services, if I'm not wrong.
Yes, that is correct. So, Darshan, sales and revenue are also, again, they are two different things. Sales is basically the buying and selling of, say, some units. Okay, it's a volume. It's related to volume. It's not related to your amount. So many a times we use the words interchangeably, but revenue is basically the money that you get by buying and selling, by basically selling your products. Okay, by basically selling your products you get the revenue, and selling the products, the volume, the quantity is sales. Okay, so revenue simply is volume into price for a company which is producing something and then selling it into the market. Okay, so I'll not be talking about services, just to make it simple for you guys to understand. So we'll take, say, ITC for example from here on. So wherever I'll be using the terms products and anything of that sort, or I'm talking about the business model, just take it from the lens of ITC, like how ITC will be doing that. Okay, so in revenue, when we talk about that, the first thing that we look at is the business model. So the business model for any company can be like, say, a business to business, then it can be a business to customer, and then it can be direct to customer. So in the case of ITC, it is business to business when ITC is producing the products and selling it to other businesses. So in ITC's case, how they do it, they produce atta, okay, and then they sell it to hotels, they sell it to quick service restaurants. So that is basically business to business. And when they sell it to wholesalers, and then the wholesalers sell it to retailers, and then the retailers sell it to the end customers, that's basically a B2C, wherein we as the end customers are consuming the atta, like the Ashirwad atta which has been manufactured by ITC. Okay, so that's basically kind of a source of the revenue generation for a company. That's the business model that we talk about. And business model is very much like the foundation of any company. If you want to understand about how a company operates, or how, whether the company is doing good in terms of the competitors and all these things, like whenever you want to understand the company based on these matrices, the very first thing that you will have to look about is the business model of the company. So if you are able to understand the business model of the company, and how the company is generating revenues, you will be able to understand most part of the company. Okay, then after the business model we'll look at the organic growth. So organic growth is basically something wherein the company is selling its products and generating revenue, and say, whether it's B2B, B2C, or anything, So that's basically a daily business. Okay, so daily operations and daily business from which the company is generating revenue, that's your organic revenue. And then the third thing is inorganic revenue, wherein the apart from their daily operations, apart from their daily business as usual, the company is trying to generate more revenue using another source here, like which we consider an inorganic growth, is mergers and acquisitions. Then there would be takeovers. Then there can be some investments that the company is making into another company. So you guys would be coming up with news like, say, A company has acquired a stake in B company, or A company has bought B company. So that comes into your acquisitions. So mergers and acquisitions are again simple. So merger is basically wherein one company is like collaborating or merging with another company, and they are making a single entity, or they're for running their operations. Okay, and acquisition is basically one company getting a stake of another company. Maybe it can be a, say, a minority stake, or it can be a majority stake. The company can do go either ways. So right, like in the present scenarios, many of the companies are preferring to take a majority stake in a company, so that they are able to like takes like to be, they are able to be a decision maker in the other company's operation, and then that other company's operation will ultimately help this company in order to generate the revenues. So basically two sources of revenue: one is organic and one is inorganic growth, and clubbing it will basically be a part of your business model. Then from the revenue, we'll move down to cost of goods sold. So under cost of goods sold, one is basically your raw materials. So there'll be a cost which you will incur in like purchasing the raw materials for ITC. If we are talking about again, I'll take the example of atta, Ashirwad atta. So for Ashirwad atta, basically the raw material will be wheat. So ITC will definitely be procuring wheat from, say, the millers, or say directly from the farmers. Okay, and then they'll be incurring, say, some transportation cost or logistics cost in order to get it from the source to the destination. Destination will basically be the ITC's manufacturing plant. Okay, so there will be a cost that will come up for transportation. There'll be a cost of purchase, and there'll be a cost of, say, many other things which will fall in between this particular process. Okay, so then we'll move towards the next part, which is basically inventory. So under inventory, so the companies basically do not follow a process wherein, for example, if they are making, say 1,000 tons of atta, they'll whatever the wheat that is required for making that 1,000 tons of atta, they'll obviously be procuring more than 1,000 tons of wheat. Okay, so that they will keep that wheat in stock, and then they will be using it as and when required. Okay, so whatever they keep it in the stock, that's basically your inventory. So for keeping that particular wheat in the stock, there will be another cost, which is inventory carrying cost, that the company will incur, because for managing that particular inventory, there is a cost involved. Okay, then we'll move down to another element which is very much in talks now, which we call as digital transformation. So digital transformation is something that comes up here. That's also one of a major part of strategy formulation. It's also a strategy, digital formula and digital transformation, wherein the companies focuses towards like focuses towards getting technology into their day-to-day operations, get like using the technology more and more into their day-to-day operations, so that they are able to manage their operations, manage their processes efficiently, and they are able to cut down the costs. So I'm not sure whether you guys have heard about industry 4.0. or even artificial intelligence. I'm sure you guys must have heard about artificial intelligence, if not Industry 4.0, right?
Yes, sir.
Right. So artificial intelligence again is a part of Industry 4.0. So wherein the companies are using these kind of what I say, these kind of cost efficient measures, so that they are able to increase their margins. So from revenue, if we'll reduce the cost of goods sold, we'll come on to gross margins. Okay. And then from that gross margin, there are two things that the companies basically deduct or reduce in order to come to the earnings before interest, tax, depreciation, and amortization. So those two things, one is basically your selling general and admin expenses, wherein the company focuses towards reducing those selling general and admin expenses. So what comes under selling general admin expenses are basically your employee benefit expenses. So employee benefit expenses are kind of salaries that the companies pay to their employees. That's basically a major chunk here. And for basically reducing the selling general and admin expenses, the company focuses towards HR transformation and also towards the restructuring measures. So when we talk about restructuring measures, the company focuses towards reducing costs through like say cutting down on the number of employees. Cutting down, if I'll say, that means is basically reducing those employees which say are not required for the for running the daily business as usual, or maybe the company must have hired say additional number of employees which are not required at the first place. So cutting down those employees are basically part of restructuring measures. I just hope that it should not come anytime in your life, because that is something, a very harsh decision that the management has to take, but that is something that is that sometimes becomes unavoidable in a situation wherein the company is facing say some kind of issues while generating revenue or while sustaining in the market. Okay. Then there is other expenses which constitutes your rent, then some kind of discounts that the company offers, or say a payment to auditor and all these things. So that basically is a very that can be a small part, and that depends upon business to business. Then you move down to EBITDA. So EBITDA is basically earnings before interest, tax, depreciation, and amortization. And sometimes that's also referred to as the actual cash that the company is having in the business, which can be utilized for their operations and which can be utilized for their future activities. Then from EBITDA, we subtract the depreciation and amortization. So depreciation and amortization is basically say a non-cash expense or a charge that that is implied on your fixed assets, or say intangible assets as well. So here the company focuses towards how they are effectively utilizing their fixed assets. So whatever the fixed assets that the company has, say for example, property, plant and equipments, then plants and machineries, or some kind of right of use assets, wherein the company is having, say, a building which is leased out, wherein they are paying the lease rental for that and all these things. So company basically focuses towards how they are effectively and efficiently utilizing their fixed assets, and what is the return that their fixed assets are generating for them. So there is a formula for return on assets, but return on assets being like say a bigger term, will not be focusing on the total assets, will be focusing only towards the fixed assets, in order to understand like on the assets wherein I'm charging depreciation and amortization, whether I'm getting a good return out of it. So the company focuses towards getting good returns out of the fixed assets, or the fixed assets like generating a good return for them anyways. So from like subtracting depreciation and amortization from EBITDA gives you EBIT, which is earnings before interest and tax, and in simple day-to-day languages, that is also called as operating profit. Then from that operating profit or EBIT, you deduct interest expenses. So interest expenses are basically again a charge that the company is bound to pay, whether the company is earning say profits or losses or whatever it is. The company is bound to pay a charge. So that is basically employed like implied on the borrowings. So those borrowings can be say a short term borrowings which are basically for a period of less than 1 year, and that can be a long term borrowings which are for more than 1 year. So company focuses towards the debt restructuring in order to like run their day-to-day businesses efficiently. So when we talk about debt restructuring is basically, so whatever their long-term borrowings that the company is having, they try to focus on increasing the tenure of those long-term borrowings, which is also known as cash management. Okay, so the moment they are trying to increase their tenure, they will have enough time to repay their debt. So how the company does that is by like establishing good relations with the bankers, with the financial institutions, and BFCs for that matter. They make good relations with these guys in order to get this benefit of like increasing the tenure of the long term borrowings to effectively and efficiently manage their cash. Then there are interest incomes also, which is again basically your investment management. So whatever the investments that a company does, so they try to generate income out of it. So it can be say in the form of the dividend income, it can be in a form of the investments that they have made in say some kind of a instrument from where they are getting interest. Okay, so it can be the investments on mutual funds, and there can be one more thing which can come up here, which is basically hedging. So what hedging exactly is? Hedging is kind again a kind of a strategy where the company tries to minimize the risks. So how they are minimizing the risk? Say for example, in the case of ITC, when ITC is procuring raw materials, so those raw materials, uh, there is a transportation cost involved, and when wherever transportation is involved, there is oil that is involved. So for example, the company thinks that in the next 6 months there will be an increase in the price of oil. Okay, so company has thought so, and the company has forecasted basis on the external factors, geopolitical tensions, or whatever it is. The company has forecasted that there in the next 6 months there will be an increase in the price of oil. So what they will do is they will enter into a forward contract with say the oil vendors from where they are purchasing oil. They will come into a forward or a future contract with these oil vendors, wherein they will say that whatever the price may be in the future, I will procure whatever the oil that I need, I will procure it at a predetermined price. Okay. So say the oil currently is say hovering around $90 to $100 a barrel, and the company is forecasting it to be say $200 a barrel in the next 6 months. I'm just giving a hypothetical example for the understanding. So at present, the price is at $100, and they're forecasting in the next 6 months the price will going to be at $200. So to minimize the risk of the increase in the oil prices by $100, the company can come up into a forward contract with the oil vendors stating that I will be buying the oil after 6 months from you guys at a predetermined price of $100. Okay. So oil can be 200, oil can be even 95 or 98 for that matter, but the company will be paying only 100. So the downside here is risk. The downside here is minimized but the upside is that the risk has been minimized. Okay, that's the upside for the company. So that is how the company focuses towards minimizing the risk using hedging strategies. Then we also have the this one more thing, which is income from associates. Remember that I talked about inorganic growth. So inorganic growth is basically from M&As or from takeovers or from the investments made by the company into another company. So income from associates is nothing but it is linked with the inorganic growth. So whatever incomes that you are generating from the acquisition that you have made or from the investment that you have made into another company, that will basically come into your income from associates. And if the company is, say, trying to pursue the inorganic way of growth, then this particular line item like has been something that the external stakeholders focuses on more. Okay, so deducting interest income, adding deducting interest expense, adding interest income, adding the income from associates to EBIT will basically give you profit before tax. Then from profit before tax, you will subtract the tax. So tax, for taxes, the company basically strategize in a way wherein they try to like establish their manufacturing facilities or establishing their offices into areas which are kind of tax havens, wherein the companies will not be paying taxes or will be paying very less taxes as compared to India. So, for if example, the company is paying say 25% tax per annum here in India, they will focus towards places wherein they'll have to pay negligible tax, say a zero tax or say a 1 or 2% of tax. So in a way, that 25% will come down to say zero or say 1 or 2% or say 5%, and the rest remaining 20% will then add up to your profit after tax. So add subtracting the tax from profit before tax will give you profit after tax. So that's how your income statement looks like. Revenue minus cost of goods sold will give you gross profit. From gross profit or gross margin, you will subtract selling general and admin expenses, and you will subtract other expenses in order to come down to EBITDA. From EBITDA, you will subtract depreciation and amortization. From depreciation and amortization, you will come down to EBIT, and from EBIT you will subtract the income sorry interest expenses, and then you will add up interest income, and you will add income from associates in order to come down to PBT. From PBT you will subtract the taxes, and from that you will get profit after tax. That's how your income statement looks like when you talk about the internal stakeholders, how they look at the income statement. Then moving towards the balance sheet. So in balance sheet, the major focus of the companies are again only on the two, three sides. One is towards the fixed assets. So as I mentioned previously, also in the depreciation and amortization, the company focuses towards how they are effectively and efficiently managing their fixed assets, and how the returns they are getting on the fixed assets can be maximized. So sometimes the company purchases some fixed assets by doing capital expenditure, or sometimes they sell off their fixed assets as well in order to generate some cash. Then there is another thing that the company focuses on is the short term and long term borrowings. So the company always try to get the benefit of leverage. So leverage, financial leverage basically is like using debt or borrowing as an instrument in order to effectively run their business. So borrowings can be for, say, again, for 1 year, which is your short term borrowings, and can be for more than 1 year, which is basically your long term borrowings. So the company always try to maintain a good debt level, wherein because of which they are able to get more loans, or they are able to maintain a healthy balance sheet. And then the next thing that the company focuses on is your working capital. So working capital is nothing but current assets minus current liabilities in, say, mathematical language. So in working capital, the company focuses towards three things. So one is basically your sales, the other is inventory, and the next thing is the cost. So basically, it talks about your debtors, your inventory, and creditors. So debtors are the people from which the company is going to get the money. Okay, so debtors can be your debtors can be your vendors, basically, from where from to sorry, not the vendors but the customers to whom you have sold off something, and you are awaiting the money from them. So those are basically your debtors. Then your creditors will be the vendors, or say the people to whom the company is bound to pay. Okay, so that's basically from where the company must have purchased something and the company is liable to make a payment. And then the third thing is the inventory. So the inventory is basically the stock that has been there, let's say your go down or anywhere. So that focuses on the inventory. So the three things that the company looks out is basically the receivable days, payable days, and the inventory days. So these are the three things. And then that's kind of sum ups your balance sheet. And the cash flow again is simple, and is kind of the linkage between the income statement and balance sheet. So in cash flow, the company focuses towards capital expenditure. So whether they are planning to make a capital expenditure in the future in order to say increase their facilities or increase their production volume or something, then they'll focus on the capex. Then there is another thing wherein the company is trying to get some funds, either say from the investors or say from the markets, in the kind of, say, an initial public offering for, say, a private company turning to be a public company, or it can be in the secondary markets through, say, rights issues, or say a follow-on public offer, or say a private placement, or say a qualified institutional placements or something of that sort. So the company focuses towards getting the inflow of money. And the next thing is again a change in working capital. So they see whether they are able to effectively manage their working capital flow, whether there are more creditors which are there in the balance sheet, or whether the debtor side is more, or whether they are having like a higher inventory days, which is again adding up to their inventory carrying costs or something of that sort. So these are the three statements which the company uses in order to make strategies, which are again required for their internal purpose and also required for the external stakeholders. So I would just open up this thing for open up this for the Q&A, and I would like to understand from you guys whether you have any questions, or there is anything that we can talk about. Whether you guys understood this, whether that was a one-way talk, I was only talking about it, and you guys didn't even like give attention to it. So I just want to understand from you guys. Do you have any questions? Okay, so there is one question from Rutvik. How can companies balance risk and return when making investment decisions? So, a good question, Rutvik. So, how the company focuses towards this is in order to, like, they basically look out for the areas wherein the company can invest and the company can get more returns from that. So a company typically looks towards investing their money into mutual funds, okay, and investing their money into FDs. in order to like minimize their risk completely. They are not more focused towards directly investing into equity, because it's like unlike the retail investors wherein they are like they are kind of eager for more returns, and for getting that they are able to take higher risks as well. The company tries to minimize that risk, and the company tries to focus more towards investing their money into mutual funds, which are again run by successful fund managers. So in a way, they are with that they minimize their risk. And the another investment that the companies basically do is investing into FDs. So FDs are again like kind of instruments which give you good returns, like say 6 or 7% returns, and they are kind of less risky, or they're kind of no risky as well. And there are many companies who also focuses towards investments into gold, okay, which is again like kind of less to no risk instrument. So yeah, these are main things like mutual funds, FDs, and golds. And if say a company which is more focused towards if they're having that ability to take higher risks, then they go for derivatives, then they go for equity markets as well. I'm not denying the fact, but the companies which are smaller in size, they focus more towards managing their risks and getting a substantial return by investing into FDs, mutual funds, and gold. I hope that answers your question, Ritik. Okay. Anyone else? Any questions? Either you guys were able to understand whatever I talked about, or you guys didn't understand it at all. Not sure.
So let me start this question. Huh? Okay. Continue, continue. Who were talking? Continue, please continue.
Okay, so I would also like to introduce. So there is a bit amount of time. So I would like to introduce one more topic, which is basically valuation. Okay, so when do we talk about valuation is something that's very interesting. So we talk about valuations when the companies try to go for fundraise. Okay, so that fundraise can again be from the say investors, angel investors, or say venture funds, or say private equities, or these kind of investors. So again, it can be from say primary markets when say private company is going to go public for the very first time. They are reaching out to retail investors like us, and they are also reaching out to institutional investors who are not been a part of the company previously. So it can be from the investors perspective, it can be from say IPO perspective, and it can be from investments which the company is trying to get from the secondary market as well. So each one of these stakeholders, they focus towards the value of a company, and how the company is valued is basically using say 3 or 4 methods which are already been there in the market and widely used. So these methods are, one is basically your dividend discount model. The next is the discounted cash flow. Then there is say a peer comparison model, which is your relative valuation. Then there is transaction comparables, there is trading comparables. So there are these 4 5 models which the company uses or the say the external stakeholders uses in order to understand what the company's valuation is today. So I don't know whether you guys have heard about the term valuation in the first place, or that's completely new for you guys. I'd like to understand from anyone who have heard about valuation previously.
Yes, sir.
Okay. So, Sakshi, where you have heard about valuation, like in which context, apart from whatever I've just told?
Sir, in Shark Tank India.
Okay, okay, right. So, yeah, so that is something similar to how the companies look for the valuation. So, yeah, the process is somewhat similar. So, in valuation, what we basically do is we use these, whatever the three statements, three financial statements that I talked about, we use these three statements, and then, like, basis on whatever the company has done in the past, what the company is doing in the present, we forecast the future. Okay. So, how the company will do in, say, the next 5 years or next 10 years down the line. So for that forecasting, we generally take some kind of assumptions. So that assumptions can vary depend upon business to business. So sometimes the companies provide a guidance, say one year down the line, how the company is going to perform, how the revenues are going to be, like based on the current prevailing this scenarios in the market or whatever the company is doing internally, how the company will do, say, in the next 1 years or 2 years down the line. And basis on that direction, the analysts or whomsoever is calculating the valuation, they will do their forecast for, say, the next 5 and 10 years. So we basically forecast the three financial statements, and then we use a methodology which is best suited for that company, or which is best used in that particular industry. So, say if a company is kind of very, say, early into their business, or say you must have heard about the terms pre-seed or seed, like the companies in the ideation stage, or say in the pre-revenue stage, or in the revenue stage, or in the post-revenue stage, whatever it is. So, basis on that, we use a valuation methodology in order to determine the valuation of a company. So, the dividend discount model that we talk about is used for the companies that are giving dividends, like, say, uh, in their course of business. Say it can be every quarter, it can be every, say, semi-annual, or it can be annual as well. So, which whatever, like the company which gives dividends uh, continuously, for those companies, for determining the valuation of those companies, we basically use the dividend discount model. The next is your discounted cash flow. So discounted cash flow is nothing but discounting the value of the cash, the future value of the cash to present. Okay. The present, basically the present value of future cash flow is the uh, term that we use under discounted cash flow model. So under discounted cash flow, the main thing that that the analysts calculate is the net present value or the terminal value. So this valuation is again a very, like, very important determinator when the company is formulating a strategy. Remember, I talked about inorganic growth, wherein the company is focusing towards mergers and acquisitions or towards investments. When a company is focusing towards mergers and acquisitions, or say the investments or a takeover, the company has to understand the value of the other company in which they are trying to make investment, or they are planning to acquire. Okay, so for acquiring that, they'll have to pay a certain value, and for determining that value, they are going to use a DCF, or say a DDM, or say a relative valuation. So that's why. So if the company that which is going to get acquired by, say, this company, so if that company is paying a dividend, I'll use a dividend discount model in order to calculate the valuation of that company. If the company is not paying a dividend, and the company is, say, has been into the business for, say, in the last 3 years, 5 years, so I'll be using a discounted cash flow model. So under that, I'll be calculating the present value of its future cash flows. So whatever the future cash flows that I have assumed based on the forecasting that I have done, I will take the present value of that and I'll use that value as an indicator for my acquisition. Okay. Then there is another form of valuation, which is your relative valuation. So in relative valuation, the company focuses towards the other companies which are there in the industry. If, say, for example, ITC is going to acquire a stake in, say, Marico, for example, although they are not going to take it because it's again a big company as well. But if ITC is planning to acquire Marico, this hypothetical example, so ITC will try to get the value of Marico. If say Marico currently values at say 2000 crores and ITC is having that much amount lying in their banks or they are planning to take up a loan or something in order to acquire that particular company. So ITC will try to focus on like forecasting the forecasting Mariko's statements and getting the value of the uh, getting the present value of how Mariko will be in the future. So if say they are basis on their forecast, they are saying that Mariko will in future Mariko's value will be say 50,000 crores. So they will discount that and they'll come up to a present value, and that present value can be say higher than what Mariko's today's value of 2000 crores is, but it can be lower than what Mariko's today's value of 2000 crores is. So whatever the value that will come up, that particular value will be used at the time of acquisition of ITC acquiring Mariko. Okay, that particular value will be used. Then that is basically your DCF in relative. When ITC is going to acquire Marico, ITC will also look at the value of other companies which are operating in the similar space. So there can be other companies like say PNG or say HUL or any other FMCG company which is operating in the same space. They will look at the value of those companies, and basis on that, they will try to determine the value of Marico. Again, that value can be more than 2000 crores, that value can be less than 2000 crores. That will depend upon the value. That will be depending upon how their analysts have taken the assumptions basis on which they have made forecast. Okay, so that is basically your relative valuation. And then there is transaction comparables, which again comes up for companies which are say wherein we don't have too much of data, we are only aware about what how much of the transactions they are doing every year, and what is the value of their one transaction. Basis that and basis a multiple, we will be valuing the company, and basis on the value that has been arrived, the further decisions will be taken care of, whether the company should be acquiring that particular company or the company should make only say a minority investment wherein they are investing only say 20% or 20, they are taking a stake of only 20% or 25%, or whether they should be taking a majority stake if not total. So yeah, these are the say few of your valuation concepts which are used very frequently into the industry. So any questions on the valuation part? Anything that you guys didn't understood or you didn't that you need more clarity or anything of that sort?
Students, there is still time. You can interact with sir. There is still 10 minutes. You can interact. If you are having any questions, please ask.
Hello. Hello.
Yes, we can
I'm
hear
on.
you.
Yeah. Hello, sir. Pallavi here.
Yep.
Actually, I just wanted to know, for valuation, but like as you said, how to calculate or how to we can get the valuation of the particular company. But if company has any loan or any debt, so how we can calculate the valuation or how we can find out?
Right. Good question, Pallavi. So what happens is, say, I'll take an example of discounted cash flow model here. So under discounted cash flow model, there are many things. So one is basically your weighted average cost of capital, wherein we calculate the cost of equity as well as cost of debt. So cost of equity is something if the company is planning to raise equity funding from the investors, from say the angel investors or from VCs or from say the IPO, how much um the what will be the percentage cost that will come up on that. And then there is cost of debt, which is basically your interest cost. So if a company say trying to get the funds from say banks, so kind of a secured fund or say a unsecured fund, or they are trying to get it from any debenture trust or say any other financial institutions, what is the interest rate that the company is going to pay? So taking both of them into consideration, taking the weighted average of both of them into consideration, we arrive at a weighted average cost of capital, which is your WACC. Then using that weighted average cost of capital and a long-term growth, we try to determine the valuation of the company. So the valuation of company is not only the equity valuation of company, it's the total valuation of company, which includes your equity as well as debt. Okay, so this that term is basically the enterprise value that we talk about. So when we talk about only equity value, that's your market capitalization, which is the value of the outstanding shares which are there in the market. Adding the debt and adding any other liabilities on it will basically give you the enterprise valuation, which is your total value of equity and debt. And then using that in basically that enterprise valuation is kind of the value of the company. So that will be your present value of the company, which is having equity as well as debt. But then in order to determine how much investment you are going to make, you will obviously do a forecast, and then you will calculate the present value of the future forecasted cash flows. So then whatever the value that will come up, that will be the actual valuation of company, taking everything into consideration, taking the past, taking the present, taking the future, everything into consideration. That will be your enterprise value. And that enterprise value and the present enterprise value can be different, it can be same. Okay, but in most of the scenarios, that is different. Since we are forecasting the revenues and everything, obviously not on a 0% rate.
Okay, got it. So one question actually. See, while investing the money, see, which we need to consider balance sheet or cash flow.
While investing the money, so I actually didn't get your
Analyzing
question.
the company, we can say like, see, my question is like, see, while I analyze any company cash flow report or any company's balance sheet, so there is a huge difference. So see, balance sheet is showing what the depth or like balance sheet actually is showing their loans and their investment. Okay, but cash flow is showing how much money they are getting actually. So which one is best to analyze any company financial condition?
Pallavi, just to answer your question, I would like to ask a counter question. So, according to you, with like in these three financial statements, income statement, balance sheet, and cash flow, which is the
Hmm.
most important statement according to you?
Obviously, cash flow statement
Why?
because it shows na how much money actual company is earning or how much they are getting.
So, I think that answers your question,
Okay.
right? So,
Yeah, right.
So when we say cash flow statement is the most important statement, it's
Mm-hmm.
not only the most important statement from the internal stakeholders point of view. It's also the most important statement from the external stakeholders point of view as well. Because
Okay.
balance sheet is always as on date. As on
Hmm.
31st March 2024, these are my assets, these are my liabilities, this is my
Liabilities, yes.
position. Okay, it's
Hmm.
just a position as on date. It will not give you a clear picture as to how your flows have been during the course of that year. Okay, in order to understand how the daily like how the operations have been during the course, you will have to understand how much money came in and how much money went out. So inflows and outflows, you will get it only from cash flow.
Cash flow, right. Yes, yes, got it. Thank you.
Anyone else, any questions?
Are there any questions, students? Okay, then shall we conclude? I guess there are no questions, sir.
Okay.
Thank you so much, sir, for accepting an invitation and guiding our students on strategic formulation and decision making in industry. The session was really very informative and knowledgeable because the students were really very interactive with you. So, on behalf of Matrix School of Management Studies, I thank our guest of honor, Mr. Anurag Mishra, for guiding the students. I thank our director and express my gratitude for your support and direction throughout the session. Thank you so much, sir.
So thank you to the director and obviously thanks to you, Mrunal ma'am, as well for having me here.
Thank you so
Thank
much,
you.
sir. Thank you. Okay. Students, please fill the feedback form before leaving. All the students are requested to fill the feedback form, which is given in the chat box, and then you can leave the session.